All right. It is Wednesday, 9 o'clock. For everybody who is watching this live, welcome. For everybody listening to the podcast, you should enjoy this one. We're going to be talking about the New York Stock Exchange and the NASDAQ, the fact that you can actually invest directly into those platforms. A lot of people don't know what that means. We're going to talk about it today. So if you have a moment, definitely share this, tag a friend, get comfortable. It's going to be some good information. This should be a fast one. So we want you all to know if you have questions, please put it into the live and we will get to them as we can. So Leon, if you can give us a little bit about why this topic today.
Yeah, so we chose the topic today because it's one I've never heard. I've never had a discussion with anybody about this. And I was thinking the other day, IEA is all about investing. We're all about stock market investing and investing in general, but primarily stock market investing. And everyone's always looking for kind of that sure. Nothing is a sure thing, but that as close as you can get to a sure thing as possible. Every stock is a gamble. We all know that. It's 50%. If it goes up, 50% it goes down. We never know. But we always look for the stocks that have, kind of the most likely or the safest earnings and sales, because generally that's what stocks trade on. Well, I don't know if a lot of people know this, but I want to say it's north of 90. It's the majority. The percentage, I'm not exactly sure, but it's up there in the 80s, 90%. That every stock that trades in the United States generally trades on the New York Stock Exchange or the NASDAQ, right? So every time we make a trade, buy or sell a stock, it's usually trading on one of those exchanges. And also, anytime you buy or sell an option, it's being traded on one of those exchanges as well. And but a lot of people don't know that. So a lot of people know that right now, commissions for us as retail traders have gone away, primarily because of Robinhood. Robinhood came in the game and changed it, where trades on Robinhood started off as free. Before Robinhood, we all paid about anywhere from $7 to $10 per trade. So you're paying $14 round trip, $7 in, $7 out on average. So those are fees we had to pay. Robinhood came in and dropped those fees to zero. Well, part of the reason why brokerages had those fees was because the exchanges themselves charge broker fees, right? So every time we make a trade, you buy a stock, right? Right now we don't pay anything, but your broker does pay something to that exchange. So for instance, if you buy, let's say Amazon on the NASDAQ, right now it's going to cost you nothing to make that trade. In other words, your broker doesn't charge you commission, but your broker does pay a fee to the NASDAQ stock exchange for the execution of that trade. Or let me tell you that it's either your broker or the market maker. But either way, there's a fee paid to the NASDAQ or the NYSE, the New York Stock Exchange, for your trade. So every time you trade, you buy something, the exchange, either NASDAQ or New York Stock Exchange, collects a fee. And then if you when you sell, same thing. Anytime you sell a stock, there's a fee charged. So my thing was okay, do a lot of people want to know that this is possible? And two, does anyone even think about this? Because again, we're talking about, kind of like sure things, sure bets. We want trades that again, companies that have, sure bets or relatively good earnings, relatively good sales, and things like the exchange where all of us are buying and selling daily and trading daily, pretty much a sure thing. That's not going away. It's almost like banks. Like banks are always going to be there. Stock exchanges are always going to be there. So Brent, you can pull up slide one.
Yep. And another thing too is when you're putting your money there, anybody who's part of IEA has heard either Leon or myself talk about move as an owner, and we're putting all this money into the market, right? And we're paying these fees that some of us don't realize we're paying, or that are being paid out. I shouldn't say it's us, but in that whole space, understanding okay, I'm investing in all these companies that go through these exchanges. Why don't I just invest in the exchange? Many of you all don't know how, so we're going to go into it today and actually educate you on really what it means to, have money go into the exchange.
Right, and if you think about it, the exchanges, again, the New York Stock Exchange, the NASDAQ, where essentially all of our trades when you buy or sell a stock is executed. I almost think of it almost like a backstop, or almost like a safety net, because if you buy a stock, right, and say that investment just goes bad, if you own, say, the NASDAQ or the New York Stock Exchange, they're collecting that fee on your trade, regardless, if you win or lose. So if you own that stock, and remember, this is happening across every stock in the world, right? Well, not every stock in the world, sorry, every stock listed here in the US. So even if you lose on a trade, they're still getting their money. Like, they're still being paid every time you execute a trade, be it a stock or be it an option. So whether you lose or not, that stock is that company, New York Stock Exchange or the NASDAQ, is getting their money. So it's like, why don't we own these stocks? And then one of the analogies I think about is Amazon, right? I mean, a lot of us do our shopping on Amazon. But it's like, okay, if you're buying from, say, Nike or Apple, or maybe some clothes on Amazon, every time you make that purchase, Amazon gets a piece of that, gets a piece of that pie. So it's like, yeah, so say you own Apple stock and you maybe buy your Apple phone on Amazon. Okay, cool. But why not get so you own Apple stock, you get paid for owning that stock, but why not get paid also on the platform where you bought the stock at, which is Amazon? So every time something's bought on Amazon, Amazon gets a cut. So we all know everybody that pretty much we know buys on Amazon, here and there. So it's like, why wouldn't you buy the platform instead of just buying the company that sells on Amazon? So that's kind of the analogy comes to mind for me when I think about the stock exchanges.
Yep. And so if anybody is watching this and you keep the majority of your money in a savings account, please watch this entire thing and share it with everybody in your community, because that you're losing. And it's the best way that we have to change the way we interact with our money. And so for everybody who's listening to us on our podcast right now, we're pulling up a chart, and it's our first slide when it's talking about, did you even know that you can invest in the NYSE or the NASDAQ? And just to kind of give you just a really quick history lesson of the NASDAQ in particular, the NASDAQ it was a software that replaced ticker tape. And if anybody's familiar with the market, there's these symbols, NDAQ, ICE, those are ticker symbols. And the ticker symbol is the abbreviation by which the companies trade their securities on various exchanges. That used to be done via a piece of paper, and this paper was ticker tape. And so somebody at one point was just writing it down in like a notebook, like on a ledger. That's how it originally was done. Originally it was done just word of mouth, but then it became a ledger where they created abbreviations. That ledger then developed into what was a ticker tape. And it was this long piece of tape that just told the current prices of the stock and the ticker symbol. They needed the ticker symbols because there wasn't enough room on the piece of paper. Isn't that crazy? And so the other fun fact is, it originally, when the NASDAQ came along, it was just replacing that system. And the ticker tape was done because of the telegraph machines that were developed to relay symbols at long distances and information over long distances, that disallowed or made it no longer needed for them to actually have a horse and buggy deliver information from city to city to town on how companies were doing in the stock market. So just in short, the NASDAQ stopped a lot of information manipulation of stocks because it was now automated, and people couldn't manipulate the information the way they could when it was somebody either writing it down or somebody punching it in. Still could be manipulated back then, but now it's all automated.
Yeah, so NASDAQ was the first electronic, as Brent said earlier, quoting system that then turned into an actual exchange where you actually have buying and selling of stock. The NYSE, we all know that kind of that famous board, or that famous place they show on a lot of times on CNBC. That's all now electronic too, but they still kind of have that quote unquote the Wall Street location, the NYSE, just for theatrics. But it's not needed. Like for instance, the NYSE floor that we see on TV closed down during COVID, but of course the markets did, because the markets are all electronic now. So it's just more symbolism. But okay, so getting back to the point. So our point is that what we're saying is, again, we're all doing all this trading, we're all doing all this investing, but a lot of us don't know that we can actually invest into the platforms where all this trading takes place. Think about it. Companies like Apple and Amazon, these big Walmart and Apple, they're trading millions, if not tens of millions of shares per day. Every time a trade happens, these exchanges get paid, and here's how they get paid. So the first one is institutional trading fees. So what that is, it's kind of like the commissions. So every time a trade happens, they're paying a fee to the exchanges, and they used to cover some of that by our commissions. The commissions that we used to pay, they would then use that to kind of cover some of the fees that they pay to the exchanges. But that's no longer there now. So these our brokerage firms are eating that fee. They have to pay that on their own. But that's one. So every time a trade happens, the exchanges get paid. Another one is listing fees, right? So every time a company goes public, so think about right now, any company that's that's currently public paid a listing fee, right? There's a one-time fee, and then every year that they're listed, they pay a recurring annual fee. So not only do you have the trading fees that happen per day, they're also getting these annual fees every year from these companies for being listed on the exchange. Again, another pot of gold that's not going anywhere. Data fees, the brokers that we all use, the quotes we get, the ticker symbols, and all the information we get from our broker comes from the exchanges. That's a fee that the brokers have to pay again to the exchanges. Another charge. Software technology services. A lot of our brokers actually built into their broker platform software is software from the exchanges themselves to actually be able to provide those quotes. It's another way. And also, a lot of this software and technology services on the institutional side, we're talking about hedge funds and like mutual funds. They have a lot more sophisticated software that the exchanges sell to them that gives them access to the to the exchanges themselves. And then last one is regulatory fees. The SEC oversees all of this, and for all this to run smoothly, there's certain regulations that all these companies have to abide by, and there are fees that go along with that. So these are the 5 primary ways that the exchanges make their money. And again, these fees they may fluctuate because you have some companies that are delisted, so their listing fees may go down and the annual fees may go down some. Trading volume goes up and down. As markets get hot, markets cool, they go down. But generally, it's a very steady revenue source because again, the stock market, as we all know, as we all play in, is one of the most actively, involved in mechanisms in the United States. I mean, there are tens of millions of people that trade in the market every day, and it's only gotten more active since COVID.
Yeah, and so, also too, you think about what's happening with so many people looking for new ways to make money, and the invent of the Robinhood investor. These people traditionally didn't invest. They had their money in a savings account. They had their money somewhere else. And again, if you have a savings account, and I'm saying this on purpose, and I know I said it already, but you have to change the way you manage your money. If you're in a savings account, you're just dying a slow death, financially. And so we now have all these new investors out here who are in these markets. They're not going to leave. Like all these Robinhood investors that came from like nowhere, they're not going away. They're realizing how much more money they can make in the market than they can in the stock market. And what's really happening is you have these sophisticated investors and unsophisticated investors feeding on each other now. And it's going to increase. Also, the wealth gap in America is ridiculous. So we're talking about predominantly African American communities and communities of color that don't participate in higher earning investments like this. So I really hope that you all are paying attention, because when COVID is done, there are going to be those people who made the switch mentally to start being better overseers of their money, and those that decided, well, I'm just going to hold on to everything and do everything the way I've always done. And when the smoke clears, if you're still in the bank account, you're losing the race.
Yep. And to that point, remember, inflation is typically 2 to 3% annually per year. Your bank account, your savings account is paying you. And as I always say, the Federal Reserve has recently cut interest rates to basically effectively zero. So you're getting, on the high end, you may be getting 1.5 to maybe 2% on the high end. But I looked it up the other day, the average interest rate paid on a savings account is 0.6%. 0.6%. So less than 1%. So
hold up real quickly. If you're making less than 1%, it's going to take you over 80 years for your money to double. 80 years. So if you feel like you have 80 years to just let your money sit, and I don't even know why you watch this or listen to it.
Right. Okay. So yes. Okay. So as we're saying, so those are ways that these exchanges make money. Those are ways that aren't going anywhere. They're steady. they're recurring, a lot of them. And also, so as you the recurring fee, the listing fee every year is recurring. But also remember, a lot of those technology fees that are, so our brokerages subscribe to a lot of these data fees that are recurring, and also technology services, that's maintenance. Those are tech services that the exchanges also offer to our brokerages to upgrade software, things like that. So these are relatively stable streams of revenue that that the exchanges get, and that, again, not to mention that that there's every time we make a trade, there's a fee exchange. So all right, so now looking at kind of the details now. So here we have the exchanges 2019 sales and profits. So on the left hand side we have NYSE. So the ticker symbol there is ICE, and the reason it's ICE is NYSE is owned by a company called Intercontinental Exchange, and the Intercontinental Exchange is what they are. So they're basically a firm that owns exchanges, right? So they own stock exchanges, they own commodity exchanges, and they own a lot of these here. Well, they own the NYSE here, and overseas in Europe and Europe and Canada, they also own similar exchanges there too. So the exchange model is the same pretty much everywhere. The revenue streams I showed above are going to be the same. They are here as they are overseas. So again, it's a model where the revenue is pretty stable, as long as, again, exchanges are going to be around, and we know they're not going anywhere. So the ticker symbol for the NYSE is ICE. If you buy ICE, you're not just buying the New York Stock Exchange. Again, you're buying into a company that owns exchanges around the world. So just know that. But okay, so the revenue for Intercontinental Exchange last year was 5.2 billion, and their profits were 1.8 billion for a 36% profit margin, which is great. I mean, that's a solid profit margin. So what I'm doing here is I'm showing you those revenue streams up top, and then what it actually translates to on the bottom, actually showing the actual numbers. So we're looking at a profit margin for the New York Stock Exchange parent company at 36%. Now for the NASDAQ is wholly owned by the NASDAQ. There is no parent company. It's just the NASDAQ owns it. And the NASDAQ is a considerably smaller exchange than the NYSE, and as you can see, it's reflected in the revenue. So the revenue for the NASDAQ was 2.5 billion for profit around, let's say, 760 million for a 30% profit margin. So again, very solid profit margin for this exchange as well. So the point of this, again, was to bring home that all of us do all this investing and trading every day, or maybe every other day, or maybe every other month. But none of us, one, a lot of us didn't know that we could actually own the underlying exchanges, and two, we didn't know how the exchanges made money. Well, here's how they make money, and yes, we can actually own them. And as I said earlier, for me, I think of it kind of like a backstop for my investing, because if I own the platform that all my investing happens on, even if I lose on some of my trades, some of that money that I lost is actually going to the exchanges. So why not own the company and kind of backstop some of my losses if my trades go bad by owning the exchanges themselves, because they're getting paid regardless. No matter what happens, buy and sell an option, buy and sell a stock, the exchange are being paid. So these I feel are two solid long-term investments to kind of, and they're both they're not very volatile. They don't move around too much, but they're solid. They're solid, steady growers. And for the NYSE or ICE, they pay a 1.21% dividend, and the NASDAQ pays a 1.55% dividend. So they're both below what I like to see. I like to see at least 2%. But again, if I'm like, to me, the dividend for these companies is gravy, because these are such solid growers, such solid profit margins. The dividend to me is gravy. So I wouldn't look at these as dividend plays. I look at these more slow growth plays.
All right. And when you guys take a look, I would love to know how many of you all even knew this was possible, because these are things that weren't shared with us in school. I was a banking and finance major, and none of my professors ever talked about investing in the exchanges themselves. I mean, now we kind of start the conversation with spiders and how to track, but we don't look at where our money is overall, and also what feeds our money. Because I promise you, like, if you have your money in the bank, whether you think you're in the market or not, you're in the market. It's just that the banks are getting all the interest and giving you this very small portion as they continue to grow, because they do get interest from money that they invest. They do get interest in money that they lend to other people, and you get you get the minority share of it. So why not stop the way we move our money and actually get involved in the exchanges that are producing all this income? And there's just an insane amount of startup companies that are now preparing for IPO because of everything that happened in this COVID environment. So there are these companies marching their way to these exchanges, and Leon and I see it because we research it and we know just how many of them are out there. But trust me, we're not giving you all this information because it's bad. This is like really good information. We hope that you all are paying attention.
Yeah, that's a good point. So anytime you all hear about the next big IPO, don't just think of it. Don't think about it as, ooh, I got to buy. I'm going to get in on this IPO. Think about it as that company that's going public had to pay a listing fee to the exchange, be it the NASDAQ or New York Stock Exchange. And then on top of that, every year that they're listed, they're going to pay one of those exchanges an annual fee for being listed. Yep. So kind of expand your mind, just thinking, "Ooh, I got to get into the hot stock," because as we know, that IPO that's coming out may or may not, it can fail. Like you can get in it and lose all your money. Who knows? Or you become a millionaire. You don't know. But what you do know is that whatever exchange is listed on is going to collect that listing fee. It's going to collect that reoccurring annual fee, and it's going to collect that daily trading fee. So when you hear about an IPO, just think about it in those terms. Think about buying the underlying platform and not just the IPO itself.
Yep. All right.
So the key takeaways from this are that the NYSE and the NASDAQ are the platforms where the majority of stock and options trading takes place. So as we said, these are the foundation, the platforms for everything that we do, mainly here at IEA, and anyone out there watching or listening to this. Anytime you make a trade, stock or option, it's taking place on one of these exchanges. For every trade, there's an associated fee that the two exchanges collect. If a trade is a winner or a loser for an investor, either way, the exchange is still making their money. So if you invest in XYZ stock tomorrow, hold it for 6 months, and it ends up being a loser, okay, you're out your money. But the exchange is still getting their money. They're getting the money when you bought the stock, they're getting the money when you sold the stock, and they're getting the money from that company for being listed every year on the exchange. So again, think about the platform behind every trade that you make being the exchanges.
Yeah, that's like being short and long on a stock.
Right. If anybody knows that may be a little deep.
All right. This is cool. We can go to the next one.
Yeah. And last point is all companies listed on either exchange pay a recurring annual fee. So just goes back to the point that if for every year a stock is listed on the exchange, there's an annual fee that they're going to pay. So it's almost like a subscription model, which is all the new rave, for these new tech companies. But these exchanges have been doing them for decades. So we just want to bring this to your attention. That we can also buy the platforms themselves. We can actually buy the exchanges themselves, where all of our trades are executed. And every trade that we do, these exchanges are collecting money per transaction, and they pay dividends. They're not the highest, but it's still a dividend.
Yeah, and so there are a number of like exchanges that are getting created like right now. And some people know about them, some people don't. Leon and I, we just bought into one of the companies that's actually planning on creating an exchange. So do you know if we're second or third round?
I believe it was third because the pitch page had 3 at the end. So I believe it was that third round.
Yeah. So we're third round investors in one of the new exchanges that might be coming out. Imagine being an early investor in the NYSE or the NASDAQ. And I mean, the revolution is happening financially, and you can either be part of it or you can just watch it happen. And we do these lives every Wednesday in this podcast. So you all can take this information. And we're not even saying everybody, join IE8. I mean, we hope that you do, but if you join Investing Education Academy to learn more about how to trade, how to invest, and become a part of a community of stock enthusiasts, we had 80% growth in August. So was that accurate?
Yeah, 80% growth.
So we had 80%
membership growth.
Yeah, 80% membership growth in August. So we're growing, and we just want as many people to get this information as possible. And we're not saying it because we just want to keep growing. We're saying we had 81% growth because we're providing really good content. And just to give you an example, like when we first picked Tesla, Tesla has gone through like the ringer in the last few days, but if you were on for our stock picks, which we're about to give you in a couple minutes, and you picked it back then with us, even with all of the turmoil it's going through, if you would have picked Tesla around the same time that we chose it, you'll still be up over 62%. Over 62%. And this is a company that's seen like a 40% drop in the last like 6 days. And I mean, there's reasons for it, and we talk about it on the platform. And many of our members said they were really happy that some of the videos we put out explaining the situations helps. But if you aren't ready to like tackle this on your own, please become a member of IEA. It's www.iaamembers.com. And I'm not really even saying it for us. I'm saying it for you. I'm saying it for our community. Let me say it that way. We have to learn how to be better stewards of our money.
Big time. Yeah. The savings account thing is, and I just want to make one last point on that. So it's gonna be a little wonky, but just bear with me. So the Federal Reserve, I don't know if anybody knows, but the Federal Reserve, so banks follow the Federal Reserve when it comes to setting interest rates for their savings account, checking account. The Federal Reserve cut interest rates recently to basically zero because of COVID to keep money kind of flowing. But they did something historic about 2 weeks ago. Jerome Powell, the head of the Federal Reserve, came out and said, so basically before their mandate was when inflation, what they dub inflation, whatever their math is, when it hits 2%, that's when they would then raise rates, right? So they would take rates from whatever it is at the point and then raise rates because at that point they're saying the economy is getting too hot. Jerome Powell came out about 2 weeks ago and said that 2% mandate is now fungible, right? So it can float. It can go a little above 2. So we don't know what their mandate is now for when they're going to raise rates. But basically what they were saying is that it can go anywhere, and some of the Fed governors come out and say it can go anywhere from 2 to 3%. So what that all means for us, if your money is in an interest-bearing asset, you're not going to earn any money on. You're not going to earn any return on that money.
You're losing. Just say what it is. You're losing.
Well, no, yeah, they're losing. But I want to make the point that you're not going to get. You're not that interest rate that you're earning right now, which is like less than 1%, is not going to move up off that number for at least 3 to 5 years. The Fed basically said they're not touching rates for the foreseeable future until inflation, which right now in their world is sub. I don't know. It's like 1, maybe below 1%. It's nowhere near their mandate of like 2 to 3%. So what I'm saying is, for the foreseeable future, if you're in an interest-bearing asset, which is like a bank account, savings account, you're not going to get any return on your money for at least 3 to 5 years. You're going to lose money every year for the next 3 to 5 years on that asset. So that's why Brent and I always stress, like, you got to get your money out of the interest-bearing assets because they're not bearing any interest. I mean, like I said, the average rate right now is less than 1% on interest-bearing assets. So that's why we got to get our money into things like the stock market, into things like real estate, into things like entrepreneurship, and please get at it. Please get at that savings account. But I just want to say that because I want to make the point that if you have like hopes and dreams that at some point soon interest rates will rise, they're not. The Fed has said it's not happening. No go for the next 3 to 5 years. So I just want to make that point.
Yeah, and Leon and I inside the IEA platform, Investment Education Academy, we had a young man come on Saturday for our Ask an Expert section, and this guy blew our minds. He was 22 years old, Roderick Williams. 22 years old, and he's a senior at Morehouse College, and he talked to us about flipping shoes. It's something that I never gave much credence to. I was like, flipping shoes, like, okay. This guy showed us returns in excess of 200% return on investment for flipping shoes. And
that. The biggest one he told us was 1,100% return.
I didn't want to say it because I was like, you know what? Like I wanted to stay like low.
Yeah.
But
and real quick, when we say flipping shoes, so because I got questions about this, what we mean is so we're not saying like dress shoes. What we mean is like trending sneakers or trend like the hottest trend in sneakers, like your Jordans, like your Yeezys, things like that. So that's what we meant by shoes when we say flipping shoes. But yeah, there's actually exchanges, like literally
they
online
look very
exchanges.
similar to the stock exchange.
Yeah, they have charts, they have 52-week highs, 52-week lows. I mean, they have bid and ask spreads. Like, people are making money serious money in flipping like hot sneakers, and not even hot sneakers, because Brent looked up one of his shoes. Well, not saying your shoes are hot, Brent, but I didn't mean that. But I mean, it's an older pair of shoes that Brent has, a pair of sneakers that he has. He looked it up, and they're trading for like mid $200 when he paid less than $100 for them. So yeah, it's trading for like $250, and I think he paid like $70 or $80 for them. So so this guy Rod blew our mind, and we want to present that to our members, because again, we're trying to get people to think different, and the stock market again is our number one way of doing it. But as Brent just said, IEA just bought into a company that's actually looking to put out an exchange for private equity, so where companies can actually trade on the private equity market before they go public. And these are things we're bringing to the attention of our members inside IEA. So. But the sneaker thing was amazing. I had no idea sneakers were that profitable.
Yeah, so we might be doing a masterclass with him, and there's a few people in our top platform that may actually be doing some things. I'll say that. So it's so many other ways to make money, and inside of IEA, since it began, our members that we are aware of have made over $320,000 and from investing in the market that we're aware of.
Collectively, not one person.
Collectively, that we are aware of. I'm sure it is more than that, but I hope you all really take this seriously, what's happening in the market right now and where your money rests, because we're taking it seriously. And the members in IA are taking it seriously. And even, we have eye surgeons, CPAs, attorneys, doctors, fishermen, painters, college. We had 10 college students join in August. We had one young lady forego a $500 21 birthday, sweet 21, I don't know what you call it, birthday gift to get. Yeah, I know what you go, sweet 21. But she turned 21, and instead of getting $500, she elected to have a year's membership in Invest in Education Academy. And like these things, this is where we need to be. That's where we need to be. And so anyway, that was our tangent. We got to give you guys some stock picks. So that we shall do. All right. For me, I am picking Etsy. Can you see the screen, Leon?
Yes. Uh-huh.
So Etsy recently just joined the S&P 500, which means that they will be getting a lot of private equity attention. Institutional money attention. So if anybody understands how the S&P 500 works, there are certain institutional investors, meaning mutual funds, large investment companies that track the S&P 500. So by default, when something makes it to the S&P, they have an influx of investing that goes on inside into them as a result of making it to the S&P. Etsy just made it to the S&P. They're like a mini version of Amazon for what used to be the indie consumer goods group, which now is changing because Etsy has recently taken on a lot of attention that used to only be reserved for Alibaba or Amazon or a Mercado Libre, if you know what those are. So right now, Etsy's ticker symbol is ETSY. Again, their ticker symbol is ETSY. And they are trading at roughly $112.71 per share. And so for Etsy, they currently don't pay a dividend. So it's not a dividend play. However, they're still very young in regards to the age of a stock. And I think they have a great future ahead of them.
Yep. All right. So my pick is Visa. Ticker symbol is just the letter V. And the reason I picked them is because, so everyone, and Brent actually, so Brent picked earlier, Brent had picked Square and PayPal. Yeah. So those are what we call fintech, financial tech companies, which are great. I mean, they're like they facilitate online transactions via our phone or via websites, which we all love and they're great. But it kind of goes back to what we talked about today. with buying the exchanges. So all these fintech companies, these new age fintech companies that connect and let us do all these transactions, they all have to at some point connect to Visa, either Visa's network or MasterCard's network. Because when you go on there, when you go on to PayPal, you go on to Amazon or whatever, or Stripe or anything that you use to make an online payment, you're using usually a Visa or MasterCard debit card or bank card. And each time you swipe that thing, Visa's getting a piece of that transaction. So they're kind of like what we talked about today. It's kind of like that behind the scenes platform with the stock exchanges. Every time a stock is bought or sold, NYSE or NASDAQ gets a piece of that. Same thing with Visa and MasterCard. Anytime you make an online transaction, Visa or MasterCard are getting a piece of that. So that's why I chose Visa. They're a platform play, a fintech platform play, been around forever, not going anywhere, growing like weed. And all these new fintech companies have to connect to their network to be able to provide their service. So solid grower, and their dividend is currently less than 1%. It's 0.60%. Again, I'm not buying it as a dividend play. I'm buying it more as a growth story. So that's my pick this week is Visa. And I don't have the my usual sales and profits because Brent and I have been on Zoom calls all day, and we were on one right up to before this, so I didn't get a chance to do the that research. But yeah, Visa's my pick.
All right. So today the stock picks are Etsy. Ticker symbol is ETSY, and also Visa. Ticker symbol is simply the letter V. So with that being said, again, everybody, we hope that you have a great rest of your week and a great weekend. If you're interested in joining Investing Education Academy, you can find us at www.IEAmembers.com. And we look forward to seeing you on the platform. It's a lot of good information. We hope you guys are really enjoying what we're bringing to you. But more than anything else, we want to change the thought process around money. So with that being said, have a beautiful day, and we will see you soon.